according to a lot of expertise in the European market, will be the big surprise of 2014. Are you agree with this opinion?
What is very amazing actually is how the European market has performed over the last 12 months. The European stock market has increased by more than 20% because the European zone is no longer in the crisis mode. 12 months ago, we were worried about the breakup of the European currency. We were worried about a major economic crisis in Europe. And now, 12 months later, I think we can say we are through the worst of the crisis. Therefore, the stock market has gone up a lot. People are a lot more optimistic about the outlook for the European economic growth. And as we have seen in the second quarter, for example, the Eurozone is now in positive economic growth mode again. I think that is the reason why investors have very high expectations with regard to 2014. However, I would be very cautious about that. Because if you look at the underlying company fundamentals, European companies have not generated any earnings growth for the last 3 years. Also in the third quarter, in the results season, companies reported in general disappointing numbers, which confirm that the outlook for corporate profits remains extremely difficult. For next year, expectations are already very high. Market consensus expects 12% earnings growth in 2014, and given the recent results that have led to further downgrades of expectations in 2013, I think these expectations are highly optimistic. In the long run, it is actually almost exclusively the underlying company earnings that drive the share prices. So in the absence of any earnings growth for European companies, I think it will be extremely difficult for the European stock market to continue going up, considering that the 20% performance in the last 12 months were entirely achieved through companies becoming more expensive, not through companies becoming more profitable.
Could you explain us your investment strategy?
Our investment strategy is to invest in companies that deliver double-digit earnings growth in the long run, because this is the most important growth driver and the most important driver for share price performance in the long run. But at the same time, we pay a lot of attention to the quality aspects of these companies because we are long-term investors. In order to be convinced about 5-year earnings forecasts, you can only afford to invest in high-quality companies, companies that have strong balance sheets and strong cash flow generation, companies that are market leaders in global markets in niche industries, companies that benefit from high barriers to entry and also have strong pricing power. So these companies are able to generate double-digit earnings growth even in very difficult periods. Our companies in the portfolio have generated 12% earnings growth, for example, in 2011 and 2012. In 2013, they will be slightly below 10% because the currency movements in recent months have had a short-term negative impact. But we expect these quality growth companies to continue growing at a double-digit earnings growth rate also over the next 5 years because they benefit from certain mega trends, not macro trends, but mega trends like the aging population, like a trend to low-cost services and goods, a trend to more consumer spending on Western brands in emerging markets where the middle class is getting larger and larger, even though there's a slowdown in the economy there.
What's your opinion about recent emerging market slowdown and the impact that have on the European markets?
Well, the emerging markets certainly are still growing, but no longer at very attractive growth rates as in the past. That certainly can be said about Brazil and about Russia, where growth has become extremely moderate. Also, India is growing only at 5% now. It used to be 10%. And even the fastest growing economy, China, has slowed down to only just above 7%. So certainly that slowdown has an impact on many companies also in Europe, but mainly for exporters of capital goods and construction materials and so on. Whereas if you look at the quality growth companies that we invest in, they are much more geared towards the consumer spending in these countries, and consumer spending is still very strong because economic growth rates at 7%, for example, in China, still mean that there are a lot of people moving into in the social middle class. Once they reach a certain income level, they change their consumer spending patterns. and they start adopting and asking for international brands like L'Oréal, like Heineken, like Prada, just to mention Italian companies. So if you look at the example of L'Oréal, for example, they have hardly noticed any slowdown in their emerging markets. That continues, demand there continues to grow in very high single digits. Whereas in Europe, they're actually seeing an improvement in demand from very negligible growth last year to almost 3% in the third quarter this year.